There will be massive volatility in all markets. I think that's going to be a given, is that volatility has got nowhere to go but up. Volatility, they've tamped it down. If you look at the VIX and the other volatility indexes, they're relatively low. And I think what we're going to have next year will be volatility. I also think next year will be the year that the BRICS really come forth with their unit. And that, obviously that's going to create volatility in currency markets. But the world is thirsting for a currency that they can trust. Because right now, the world's reserve currency is the dollar, and you can't trust the dollar. My third prediction would be that we're gonna get some real information in many areas, I think, this coming year. And I think a good deal of that information is going to point to, you've been lied to for all these years.
You're watching Capital Cause. My name is Danny. It is December 10th, 2025, and my guest today is Mr. Gold himself. It's Bill Holter. Bill, thank you so much for coming on, my friend.
Thanks for having me back, Danny.
Yeah, it was a pleasure. And quick note before we get started, this episode is brought to you by theforecaster.biz. We have a special offer for you guys by checking out the link down below. Get the same tool that we're going to use in this video. It's a great tool. And let's go ahead and dive right into the thick of things here, Bill. I want to kick it off with what your take is on the precious metals, more specifically, gold and silver. Silver, let's go ahead and kick it off with silver. Silver is spiking, currently over $60. We had a $60 day yesterday. It looks like it's maintaining its rise today. But looking at the move for silver over the last year-to-date wise, up 105%. I mean, that is massive. That's one of the, as far as we can see from this chart that dates back to 2005, this is the biggest yearly move in silver we've had in over 20 years. So what do you...
Yeah, you probably have to go back to 19...
Yeah, go ahead.
You'd have to go back to 1980 to find a bigger move, I think.
Mm-hmm. Yeah, most likely all the way back to 1980 when we had that initial silver spike back then.
Yeah, this is far different what's going on now. I mean, now obviously back in late 70s up to 1980, that was the Hunt brothers trying to actually corner the market until the COMEX rules got changed. What's happening now, and I guess I'm going to try to wrap into this, the Japanese carry trade unwinding. They used the carry trade for years and years to borrow in order to fund, first started off borrowing in Japanese yen and investing in dollars, getting a higher yield. It was like a no-brainer, basically. But what's happened is that spilled over to far more than just buying U.S. Treasuries. It spilled over into buying assets. It was a funding tool, basically. And one of the things that it funded were shorts on gold and silver. So what you're watching now is the unwinding of 20 plus years of suppression. As the leverage unwinds and there's less and less leverage, prices are going to ultimately move where fair value is, where they should have been, and that's probably lower stock prices, and it's definitely higher metals prices, because once you take leverage away from a short seller, they have only one thing they can do, and that's buy to close the position. And I think that's part of what you're seeing now, is that the carry trade's unwinding. At the same time, people are figuring out that, hey, silver's been in a shortage for 5 years. I think silver's got much further to run. I think gold's got further to run. But even even now with the ratio at 69 to 1, it's still out of whack. I wouldn't. I would say it's the gold to silver ratio is out of whack. Anything over 35 or 40, and 35 to 40 is still elevated, but we got up to 120, which was just absurd. And anybody who did step up and buy silver has done far better than gold. Like you said, I mean, silver's been the best asset class to own this year.
Yeah, and we really are in unprecedented times, because here's a chart of seasonality. The red line is the price so far of this year, and you could see the blue line is a 5-year average. The orange line is a 3-year average of seasonality, and we are tracking well above those 3 and 5 years. Now, even if you go all the way back and do a 30-year average on price moves for the last 6 or so months, I mean, we are still well above all these other averages. Something different appears to be in the midst here.
Yeah, it's totally different. This is not a seasonal move. This is a repricing. This is the reset. You're watching the reset of prices happen before your eyes. And I think we're still early in that. I mean, I believe you can see silver well over $100 just in the current episode before this episode is done.
Yeah. Well, it's interesting because, I mean, you're one of the few people that have ever heard talk about this so prominently, and that is eventually we will get to a point of a failure to deliver. And lo and behold, a day after Thanksgiving, a couple of weeks ago, there appears to have been maybe possibly quite truly a failure to deliver on the LBMA at the tune of $2 billion worth of silver. Now, it seems like they were able to patch it up. Or did they? Because the price of silver today is at $60+. To the extent that they could, they patched it up. But I mean, they didn't bring the price down. They weren't able to control its ascent. What happened there a couple of weeks back? I'm interested in getting your take.
Well, the bottom line is you cannot print silver. You can't print gold, and that's what they did with the contracts. They printed the contracts to be sold short, but there was no silver behind. So now we're getting closer and closer to the day of reckoning, and that day of reckoning will end in a failure to deliver. And there's people out there, you can read in comment sections, people say, oh well, COMEX can never default. It's in the contract language that they can just simply declare force majeure. Well, bottom line is, you can call it anything you want, but if somebody who bought a contract in order to take delivery does not get delivery and gets cashed out in fiat currency, that's a failure to deliver in that contract holder's mind. And it'll be broadly seen as a failure to deliver. They can bring the legalese up if they want and call it force majeure or anything else, but this is going to end in a failure to deliver. And it will be a failure to deliver in New York, in London, and more than likely also in Shanghai.
And what's interesting is that they shut down the entire CME coincidentally at the same time. Now, they're denying that it had anything to do with it, do with that particular event. But come on, like, both went hand in glove with each other. What's your take on that? I mean, what were they about to lose control of the paper market if they didn't shut it down?
Well, you can see, they are losing control of the paper market, and what they did was they had a do or die moment. So what did they do? They pulled the plug and gave themselves 8 or 10 hours in order to try to fix things under the surface. Now, that said, it appears like this last episode is fixed, but what about the next one and the one after that and the one after that? Like I said, you can't print silver, and that's the problem. There's not enough silver in comparison to the amount of contracts that are trading.
Yeah. Well, let's go ahead and take a look at the projections here for silver. Actually, 1 second. Here we go. So we have, so what this tool can also do is it can actually look at past data and project out into the future in terms of bull scenarios, bear scenarios, and base case scenarios. You've got the bull scenario here for silver hitting upwards of $91 based on the machine learning model that this tool uses. $91 bull scenario. Bear scenario is at $45 or $46, you could say. And what's interesting, it's interesting it says $91 because this just broke a couple of days ago, or yesterday, I should say. There's been this massive February 2026 strike call option, and the open interest has nearly doubled to 7,100 for $80 and $85 strike call options on silver. So someone massive is placing a bet on silver right now at the tune of $85 by February. And interestingly enough, this chart says around that same range as well, a little higher, $91 here. Have you heard anything about this open interest spike on silver?
Well, you've actually seen it for a couple of years going on. After first notice day, in the past, the amount of contracts outstanding would shrink steadily to final delivery day. In the last couple of years, what you've seen is you get X amount of contracts standing on first notice day, and every month that amount standing for delivery has increased pretty much on a daily basis. So the whole character has changed. COMEX was not seen as a delivery hub. It was not seen to be a risk that there would be a failure to deliver. But at this point, it's pretty clear, everyone can see that you've got these contracts piling up, standing for delivery, but yet the inventory continues to shrink. The inventory is not there to meet that delivery.
Yeah. So, I mean, it seems like we're heading into the end game here. Also, you're starting to see these cracks on the wall. A failure to deliver a couple of weeks ago. Strike call options on $85 silver to strike on February. You're seeing the price break $60. I mean, is 2026 going to be the year where they just lose control of this pricing mechanism?
We're almost halfway through December, and I'd say, 2026 is probably the year, but we got to get to that first. I mean, there's just so many. We're talking about silver right now, but there's so many things out there that tell you the numbers, the information that we're getting are bogus. I mean, look at cardboard packaging. That's down. That shows you that there's less. There's less commerce. Look at the foot traffic through Las Vegas. That's down 18%. Look at some of the earnings reports from the retailers. The retailers, the very, very, very high end is okay, and the cheapest end is getting bigger and bigger because people are scaling down what they're buying, what they're spending. They're scaling back. We're just getting information on a daily basis that is proving the numbers that BLS is putting out to Wall Street, out to the public, that those numbers are bogus.
And we also got news today. I mean, this is just breaking news at the time of this recording, and that is that they have announced the 25 basis point rate cut today. So, what do you make of that?
And I think that was somewhat baked in. I think that was pretty much baked in. I mean, we knew we were going to get a quarter rate cut. Now the question is, where does it go from here?
Mm-hmm.
I mean, that's the way markets are. They don't look backwards; they look forwards.
And
what have you done for me lately?
And also, they cut the Fed funds rate 25 basis points, which is associated with the shorter end of the yield curve, but the long end, the 10 and 30 year yield curve has actually been going up. which
Right.
is the
Well,
market
I mean,
not buying
that's
what the
been
Fed's
the
selling.
case. Yeah, that's been the case. You could go back to 2024, the second half of that year, after the first rate cut or cuts of 1 percentage point, bond yields, 10-year and 30-year bond yields actually went up and not down. And that's happened again, not to the same extent after the last cut, and we'll see what happens with this one. Uh, the world is so leveraged at this point everywhere that if you get higher rates, it's going to bankrupt various entities. And the problem in today's world is that when someone loses so big that it makes them insolvent, then the winner doesn't get paid. And the winner loses on that trade also because the loser can't pay. And that's the danger with interest rates going higher all over the world.
Yeah, and it goes
And when
back
I
to what
say
you were
interest
talking about
rates,
Japan.
I'm talking about market rates. Yeah, I'm talking about market rates, not what the central bank does, because central banks, like you saw with the US, they can lower rates, yet the yield curve go higher, and that's where we are now.
It's just pretty much setting the stage for yield curve control, where they have to buy up their own debt to lower the interest rate.
They're going to have to do something. Yeah, they're going to have to do something because the demand is not there to push rates down. So yeah, you're going to have to, central banks all over the world, I think, performing YCC.
So you had this recent comment from Bank of America recently. I'm going to share the screen here in a second. Let's go ahead and read this quote. It says here, soon all commodity charts will look like gold. This is from Bank of America's Hartnett, and he's going bullish on commodities. So
Right.
It says, so the summary is Bank of America chief investment strategist Michael Hartnett thinks that oil and energy stocks are the best contrarian bet for 2026. He also says that the Trump administration's run it hot policy will see commodities boom and outpace bonds next year. He regards despised oil and energy sector as the best contrarian trade out there. Would you agree with that? Do you see us being on the cusp of a big commodities trade here?
Yes, I agree with that. And that's how people will see it, is that stuff, real stuff, is going to go up in price, but it's not really the real stuff going up in price. What it is, it's the currency itself losing purchasing power.
Yeah.
Another word for that would be inflation.
I mean, it sounds like massive inflation is on our doorstep.
Right.
Speaking of which, let's go ahead and pivot over to gold. But before we do that, one last look at these silver charts here. Looking at it from an overbought, oversold point of view, we are getting into overbought territory. According to, in relative terms, the last time we hit these levels around this red line here was back in October, between late August to October, and that was kind of like the local top there in silver. Interestingly enough, however, when you look at gold, gold is fairly neutral. It's a little bit elevated, but nowhere near as much as heated up as silver is. I'm going to take a look at the gold chart here. Gold's been moving sideways, whereas silver's been making new all-time highs. Is gold a more opportunistic play in your eyes now, Mr. Gold, or how does gold fit into the analysis?
Play is still silver. Yeah, the play is still silver. Just from a fundamental standpoint, it looks like there are absolute shortages on the various exchanges. A gold to silver ratio of 70-1 is still extremely high. It only silver comes out of the ground 1 compared to gold. And man discounted for hundreds of years that 10-1 ratio to 16-1 because they had to carry 10 times more silver to equal the same amount of money in a cart or on a mule or what have you. Then we got into the 80s and 90s with financialization, and that allowed naked short contracts to price the metals, and silver was easier to price than gold because it's a much smaller market. You need less money to affect the price. And that's what they've done for years, is suppress the price. But no, I still think the play going forward from here is definitely silver. You want to be overweight silver because we're probably going to get down to the 15, 20, 25 to 1 ratio. From here, from where it is here, you'd still have silver outperforming by 2 or even 3 times the gold price. So keep concentrating on silver. There's blood in the water now.
Yeah. And gold's no slouch either. You know, you look back at these yearly charts, we're up 58% on the year so far here in gold. And as we can see here, I mean, that's the biggest year we've had in 20 plus years. You go ahead and look at the seasonality. Gold's well above seasonality relative to its 5-year and 25-year average. Let's just slap on the 30-year average as well. It's well above that too. So, I mean, both metals are moving in tandem. You really can't go wrong with either one, but definitely silver has that added torque. If you want that added torque involved in your metals trade, it seems like silver's the way to go.
Right.
Let's go ahead and take a look at the projections here. Looking into 2026, both bull and base scenarios have it, you know, hitting at around heading close to $5,000 by, what is that, February, end of February, according to this modeling tool. So
I don't know what they put into that.
Yeah, but
I don't know what they put into that to get those answers.
Yeah, it just looks at past data and it's kind of like an AI model, looks at all the data in the past and tries to fit this pattern with the pattern that we've seen in the past and extrapolate out the forecast. But be that as it may.
Yeah, Denny.
Go ahead.
Well, what you just mentioned, gold being up 58%. Again, an ounce of gold today is what an ounce of gold was a year ago, 100 years ago, and 1,000 years ago. The ounce of gold doesn't change. What changed is the value, the purchasing power of currencies. And what that shows you, if gold's up 50%, that shows, I'd have to do the math, but what is it, a 30, 35% drop in purchasing power of currencies in order for gold to go, you know, from 3,000 to or just under 3,000 to a little over 4,000. Gold did not go up. That ounce of gold is still the same ounce of gold. What went down is the purchasing power of your dollars, your euros, your yen, what have you.
Yeah, that's really what it is, especially in the case of gold. I've been asking this question to my guests who I've been having on this month. Bill, I don't know if we're going to be able to talk for the remainder of the year. This is probably going to be our last interview for the calendar year. So I want to pose this to you, and that is, if you could make 3 big predictions for 2026, looking ahead for the new year ahead, what would those 3 predictions be?
There will be massive volatility in all markets. I think that's going to be a given, is that volatility has got nowhere to go but up. Volatility, they've tamped it down. If you look at the VIX and the other volatility indexes, they're relatively low. And I think what we're going to have next year will be volatility. I also think next year will be the year that the BRICS really come forth with their unit. And that, you know, obviously that's going to create volatility in currency markets. But the world is thirsting for a currency that they can trust. Because right now, the world's reserve currency is the dollar, and you can't trust the dollar. My third prediction would be that we're gonna get some real information in many areas, I think, this coming year. And I think a good deal of that information is going to point to, you've been lied to for all these years. And I think that will also add to the volatility, because if people are finding out that, you know, they were investing without real information or full information, you're going to have some minds changing, and some obviously the thought processes behind investors are going to change. So I think that's what you're going to see, is you're going to see more volatility. And I do think we're going to get some real information this coming year that a year ago, 5 years ago, 10 years ago, we would have thought that, it's crazy to think that the type of information that's going to come out, and it's not just financial. I think 2026 is going to be the year of truth. I hope.
That seems to be being the trend ever since 2020. There seems to be a trend towards the truth, and as every year rolls on by, we get closer and closer to learning more about how much we've been lied to. And of course, gold and silver is at the heart of it. It's at the heart of Exter's pyramid, and all money derives from gold.
Well, gold and silver are truth when it comes to money. A bar, a coin, what have you, is proof positive that labor, cattle, and equipment have already been used to create that coin. It's proof positive that you have value, you have wealth in your hand. You don't have to trust. The word "trust me" is not involved, because an ounce of gold or an ounce of silver, as long as it's pure, there's your trust right there. You don't have to have any trust, because you have the knowledge that you have gold or you have silver, and gold and silver are money. I think people are going to start to figure that out also, is that, you got $1 million in the bank, but poof, by the end of the year, what happened to the purchasing power? What does it buy you after a year, 2 years, 5 years?
Yeah. Let's just really quick here before we wrap things up. I want to look at the silver miners. Excuse me. Yeah, silver miners it looks like they're making this double top. We'll see if it breaks through. But silver miners are up. If you thought silver was up, silver miners are up 139% so far this year. And from a historical perspective,
which is actually lagging.
Yeah. Yep. Because
that's lagging the price of silver.
Mm-hmm. Yeah, because the price of silver is at an all-time high. SIL is still at the same level as the previous top in October.
Yeah, the rule of thumb has always been that miners move roughly 3 times, both upward and downward, whatever the metal moves. If the metal moves 10% in either direction, the miners are going to move 25, 30% in both gold and silver. So the fact that silver's up 105% and the miners are up 139%, that tells you that the miners are definitely still lagging the metal itself.
What does that mean when the miners lag?
It could be, not belief in the move. It could be people assessing jurisdictional risk and either not getting in or bailing out of positions they have. So yeah, if the miners are lagging, it shows you skepticism on the side of mining share investors.
Well, here's another interesting tidbit. Here's GDX, the gold miners index, and you'll notice that it's up similarly. It's up 134% this year, pretty much the same level as SIL, the silver miners index. However, the GDX appears to have a lot more torque relative to gold than silver does, and then the silver miners have relative to silver. As you recall, gold's up 58% this year. GDX is up 134%. SIL is up 139% this year, but silver's up 100%. So there's a mismatch here between the gold miners and the silver miners. Does that imply that there's more opportunity present in the silver miners?
Well, there is more opportunity in the silver miners, but there is more risk. As a point of fact, Mexico is talking about changing their mining laws. They're not allowing new prospective zones or leases, and I think you've got investors worried about what's happening in Mexico, and Mexico's obviously important to silver miners because it's I think it's the biggest producer of silver worldwide.
Yeah.
So it could be that it could be just fear of the jurisdictional risk.
Mm-hmm. It's interesting because fear of the greater the risk is on the silver miners, you would think that the greater the reward is on the price of silver, because that provides a headwind against greater supply coming on the market if they can't mine this stuff as efficiently as they would like to.
Yeah, I mean they're gold miners and silver miners. They are in the business of minting money.
Mm-hmm. Yeah. Well, Bill, it's been a pleasure having you on, my friend. Anything else you'd like to talk about before we take this thing home?
No, just wish everybody Merry Christmas, Happy Holidays, and a healthy, prosperous New Year.
Yeah, definitely, for sure. Merry Christmas, everyone. Bill, where can people find you if they want to see more of your work?
You just go to my website. It's simply billholter.com. If you want to contact me, there is a contact button on the site, or if you want to go directly to my business email, that is bholter@proton.me.
Excellent. We'll have the link to your website down below, Bill. Thank you so much for coming on, my friend. Guys, again, check out the forecaster.biz. We do have a special link down below. Be sure to take advantage of that special offer if you want to use the same tool we used in this episode. And remember to hit that like and subscribe. It really does go a long way in helping to support the channel. And yeah, thanks for your time, guys. I will catch you later. Bye.